What exactly is a trade deficit? Does it mean a country is losing money? Or it is just another confusing economic term that sounds scarier than it really is? Today, we are breaking it down in simple terms. What a trade deficit actually is, why it happens, and most importantly, why it matters for both countries and everyday people like you and me. So, let's start with the basics. A trade deficit happens when a country imports more goods and services than it exports. In other words, it buys more from other countries than it sells to them. Think of it like running a household. If you are constantly spending more money than you are bringing in, you would call that a deficit. On a national level, if the United States imports 3 trillion worth of products but only exports 2.5 trillion, that $500 billion gap is its deficit or trade deficit. A lot of people assume that a trade deficit automatically means something bad is happening, but the truth is more complicated. Having a trade deficit doesn't always mean the economy is weak or is in trouble. In fact, many strong economies, including the US, have run trade deficits for decades. So, if that's the case, why do trade deficits still spark so much debate? To answer that, we need to dig a little deeper into what's really going on when a deficit appears. When a country imports more than it exports, it essentially means money is flowing out to buy goods from other countries. For example, Americans buy cars from Japan, electronics from South Korea, clothes from Bangladesh, and oil from the Middle East. All that money goes overseas. But here's the twist. Those dollars don't just disappear. Foreign companies and governments often reinvest them back into the United States economy, buying American stocks, real estate, or even US government bonds. So in a sense, trade deficits are closely tied to financial flows coming back into the country. This leads to one of the biggest misconceptions. A trade deficit does not mean one side is winning and the other side is losing. Instead, it reflects choices. Consumers in the US choose to buy cheaper or better goods from abroad. Businesses choose to outsource production where it's more efficient. And foreign investors choose to put their money back into the US. That doesn't necessarily sound like losing, does it? But here's where the concerns come in. One issue is jobs. When a country imports a lot of goods that it used to produce domestically, factories may close and workers may lose their jobs. For example, in the 20th century, many US manufacturing jobs were lost as production shifted to lower-cost countries like China and Mexico. Critics argue that trade deficits accelerate this process, making certain industries shrink. On the flip side, defenders point out that although some jobs are lost, consumers benefit from lower prices and other industries like technology and services often grow. Another concern is debt. When a country has a trade deficit year after year, it often finances those imports by borrowing money or by selling assets. Over time, this can add up. For the United States, this means foreign countries hold trillions of dollars in United States government debt. Some argue this makes America too dependent on foreign creditors like China or Japan. But again, there is another perspective. Those countries are willing to lend because they trust the United States economy. In fact, the US dollar is the world's reserve currency. So many nations actually prefer holding American debt as a safe investment. So, is a trade deficit a ticking time bomb? Not necessarily. It depends on the bigger picture. If the money borrowed is being used productively for innovation, infrastructure, or investment, it can actually fuel long-term growth. But if it's only funding consumption without creating value, then yes, it could create vulnerabilities down the road. This is exactly how global trade works. The US runs trade deficits because it's a massive consumer market with high demand. Meanwhile, countries with trade surpluses, China or Germany, need places to sell their goods and invest their savings. It's a global give and take, and trade deficits are one piece of that puzzle. In reality, fixing a trade deficit isn't simple. Cutting imports would mean higher prices for consumers. Forcing exports to rise might require major changes to industries and supply chains. And sometimes running a trade deficit is simply the result of having a strong currency. When the United States dollar is strong, American goods become more expensive abroad, while foreign goods become cheaper in the United States, which naturally widens the deficit.